With one new ETF being launched a day on average, there are plenty of new fund types that offer both risk and potential reward for investors. Joining us now to discuss what investors may want to keep in mind and keep an eye on, Rincon, Managing Director and Head of ETF Sales and Strategy with TD Securities. Great to have you back on the program.
Thank you for having me, as always.
One new a day on average. There's a lot going on out there, a lot of changes, I think. So we're going to break them down in a few categories. The first one is Canadian single stock yield enhanced products. What is going on here, and how do they work with potential risk?
Yeah, before I talk specifically to this category, I wanted to bring another category into the loop because there's so many launching, and that's why they're growing so fast. You mentioned 1.4 new ETFs in Canada a day. Crazy number, by the way. So first, one of the newer products that we have, we've talked about them here before, is zero DTE options. So these are ETFs they're normal cover call funds, but instead of selling calls that are 1 month to expiry or 1 week to expiry, they expire every single day. So zero DTE, 0 days to expiry. In Canada, Hamilton launched a lineup about 2 months ago. It's been really successful, about $150 million raised so far, and it's been growing quite well. These funds generally yield between 18 to 20% on an annualized basis. So for the yield-hungry investors, very, very popular. So this is a new lineup that's new to Canada, but it's been in the US for quite some time and growing now in Canada. So I wanted to mention that before I get into the single stock yield enhanced ETF. So now on the single stock yield enhanced ETFs.
Actually, before we move on from the other one, when I hear about yields of 17, 18%, I think about what's the risk? What's going on here?
Yeah, so you're basically, when you're selling a call that's expiring every day, it's almost like a 50-50 chance that it's going to go in the money or not, so you're getting called away. So what it really limits is the upside to some degree of these funds. It's more of a yield play versus a growth play in the same way that you would have for other cover call funds, but in this case, it's intensified by the options being more short-term, having higher volatility, and as a result, higher premiums. So it's important as an investor to come in and understand that it's not really a growth vehicle as much as more of a yield vehicle, but obviously we have a lot of interest in that space too.
All right, so let's get on to those Canadian single stock yield enhanced products. How do they work?
So this is fascinating. So we've had them in the US for quite some time. They launched in Canada a while back with the US underlying. So what they are, these are funds that all they do is an ETF that buys a US stock or a Canadian stock. And historically, it's been just a US stock. So let's say a Canadian ETF that buys Palantir or buys Apple, for example. So you might ask yourself, like, why is an ETF just buying a stock? I might as well just buy the stock. Well, the actual outcome that these ETFs provide is different to that of just a stock. So what they do is that they leverage, often they will leverage part of the fund, so generally 25% leverage, and they would then sell calls over the specific stock. So they give you a yielding version of that stock or a higher yielding version of that stock. So it started with the US. And what's really exciting is now we're now having them with Canadian names. So now you can get many of the Canadian banks, including this one here, and many of the other big companies in Canada with higher yield. So you can get your traditional Enbridge, let's say, your traditional RBC or whichever other stock with a higher yielding version because it has a little bit of leverage and also cover call. So it's really exciting for those investors that already own some TD Bank but want, or RBC or Enbridge or C&Q, and then they want it in a higher yielding version. This has launched or led to a lot of launches. There's many Canadian stocks, as you can imagine, and now we're seeing a lot of those Canadian stocks being launched in ETF form with a little bit of leverage and cover call.
So what's the risk on this one?
So it's similar. You're adding leverage. Every time you're adding leverage, you're adding volatility to it. And then at the same time, you're capping some of your upside. So the risk-reward profile of owning, let's say, a bank stock looks slightly different because you are basically exchanging some of your growth for higher yield. So you might have a little bit more downside potential because you have some leverage. Your upside is a little bit more limited, but you're earning more yield instead.
Okay, so important to know the trade-offs on that one. Speaking of leverage, triple leverage ETFs, double leverage U.S. single stock ETFs. We start getting a lot of leverage here. How do they work? What's the potential risk here?
Yeah, and I don't mean to just pile on the derivatives and the leverage on for this specific discussion, but a lot of the innovation has occurred around these areas. And you just mentioned it. Another new innovation in Canada is that the Canadian regulators recently allowed the first launch of triple leveraged ETFs. Just to be clear, these funds provide daily leverage, not long-term leverage. So they're meant for daily investment or daily trading. They're not meant for long-term holdings. These funds rebalance every single day. And that rebalancing creates a lot of different outcomes over the long term. So you shouldn't look at this product as a long-term holding or a long-term hedge for those that are going to short it. This product is literally just for a one-day exposure. So what they generally do using futures and or swaps is gives you 3 times leverage exposure to an index. Let's say the NASDAQ or the S&P 500. And what we're also now getting in some cases, this new issuer in Canada is launching also 2x on certain names. So you can get some of the popular US names, let's say, in 2x format if you really wanted that daily 2x exposure.
And of course, I mean, you might think using that instrument is going to move in one direction, but it moves in the other direction. And now you're talking 2 times leverage and not just a move in itself.
That's right. That's right. And so as you mentioned, you have to be careful. Obviously, you're going to get 2 or 3 times the volatility of this product. But most importantly, the long-term returns of such products are really not always tied to the performance of the stock. They're mostly tied to the volatility of that stock, which is why it shouldn't be held long-term. It's a one-day holding product. Generally speaking, the higher the volatility, no matter if it's a long, short product, they generally, the long-term returns are actually lower or negative, the volatility of that specific stock increases. So it's actually a better product in lower volatility or generally stocks that move in one direction quite constantly. So once again, this is not meant for an investment. It's meant for day trading, but it is something for those day traders that are part of your audience that really want to get 2 times, 3 times part of an index in a day. It's a great vehicle for that.
All right, so important caveats there. So if we're talking 1.4 new ETFs on average every day, can this boom continue? Can the industry keep up this pace?
Yes.
Really?
And people, it's a big number. So let me put it into context. People would say, okay, 1.4 ETFs a day. It's actually closer to 3.8 in the US. So it's almost 4 new ETFs in the US. And the reason it can is because you can ask yourself, how many mutual funds are there? There's tens of thousands. So the ETF industry is just catching up. And just you have to bear in mind that a lot of those ETF launches are actually ETF series of a mutual fund, or basically fund companies saying, I want to offer my same strategy that I have in mutual fund land in ETF land. Obviously, the ETF space has been growing, and a lot of the fund flows in new money has been going to ETFs, so they want a part of that. It's a way for fund companies to defend their turf and see growth in assets by going from mutual fund to ETFs. So they're now launching a bunch of ETFs. So can it continue to grow? Yes. Are there going to be some kinks and issues along the way? 100%. ETFs are not the same as mutual funds. For example, as a market maker, every time we seed an ETF, every time an ETF launches, it needs a lead market maker. It needs somebody to physically seed the ETF, and those are the market makers. And our resources are being really constrained by the number of launches that are happening in the market today, especially given the size of the Canadian market versus like a US market, for example. Nevertheless, we do think that it can continue to grow, and I have no doubt that this number will be 2 times over the next year or so, because it was much lower over the last decade, for example. So for sure it will continue to grow, but without its, the path will not be straight, and there will be some complication along the way, but for sure.